We are listening to the Infosys management. We'll cut back across to them when they talk to us something about important numbers, and we have the TCS numbers. We were on standby for it. 8,130 crores, that's the number that you're looking at. I'm just awaiting for the release because I don't have the full details of the numbers. 8,130 crores, that's the number that you're looking at in terms of PAT. The estimate was close to 7,900 crores in terms of numbers. So again, a decent set of numbers. Not a very, very weird and a high number, but at the other hand, it's not that bad as well. 38,000 crores is the number that you're looking at in terms of revenue. So that's a good number. It's slightly higher than anticipation, and we are still awaiting the data on the EBIT margins and various other things. Of course, for TCS, the dollar revenue always takes a few minutes here and there. The EBIT number is 9,537 crores, and that's again broadly in line. But with considering the way rupee has been 10-15 basis points here and there, it really doesn't matter in terms of in terms of what's happening in terms of rupee, in terms of margins. So we'll just get more details. Amit Chandra, research analyst from HDFC, is with us. Amit, what's your first reaction? 8,130 crores in terms of profit number and 38,000 crore plus in terms of revenue numbers.
Yeah, so seeing the headline numbers, numbers largely seems in line to our estimate. The revenues are in line, but the profits are mostly on the higher side of the street estimates, and also what we're expecting. So as Infosys has declared the results, so there we are seeing some kind of margin pressure. So here in TCS has been able to maintain the margins pretty well as compared to Infosys. So the impact of the higher cost of localization, the US supply crunch that we are seeing in the US, so that seems not to impact the margins of TCS. We have just wait that what exactly are the margins, but overall I'm saying for TCS.
Right. So what was your EBIT estimate? I'll give you the EBIT number.
So EBIT was 25.1%.
Can you just tell me that in the absolute amount as well?
Yeah, it's 9,514 crores. 9,000.
Okay, I think that I'm doing some wrong calculation, but 9,500 is broadly, I think, what they have delivered. So assuming it's 9,500, I'll get back to the exact details. What is the number that you would think that 9,500 shows?
Yeah, so it's 25.1% EBIT margin.
Yeah, 9,538 is the EBIT margin. The EBIT number, sorry.
Okay, so it's mostly in line with what we're expecting.
Right, so when I look at the margin number, it's 25.09. Okay, you can give that benefit of the doubt, 25.1. Harit Shah is also with us. Harit, EBIT at 25.1, revenues at 38,000 crores, slightly above that, and profits at 8,100 crores. Your first reaction?
Yeah, so I think that the revenue was more or less in line or slightly above what we were expecting. Margin was slightly, a little bit below what we were expecting, closer to 24.4 or some 25.4 in that range. And the net profit, of course, is a little bit slightly on the higher side. But I think overall, I don't think there's too much to complain about, as far as these headline numbers are concerned at the moment. If we can get some idea about the constant currency, that would obviously give a better sense also.
Digital is 31% of revenues. Constant currency is up 2.4%. This is a CC percentage QOQ growth number.
Yeah, fair enough. So I think more or less, again, nothing to complain about. I think it's quite more or less in line with expectations.
Right, 2.4 is in line with estimate.
Slightly above actually. So we were expecting about 2.1, in somewhere in that range. So they've done slightly better on revenue front, on the revenue front.
Right. Just the management will be speaking in a few minutes from now. What to hear from? What would you like to hear from them?
I think, in the outlook in terms of, are they maintaining their margin band, because Infosys has just, reduced it by 100 basis points, each at the upper and lower end. So, are they, TCS maintain that? And, obviously comments in terms of the BFSI and retail verticals, which are the biggest verticals, and actually, some data on deal wins also, so that will be the underlying, strength of the business and outlook for FY20.
Right. What do you think in terms of outlook for FY20?
Well, I think there's enough visibility here. I think we should, without any problem, they should be able to achieve double-digit growth.
Right. You also heard from the management of Infosys. What would be your take on Infosys numbers?
Yeah, a bit of a mixed bag actually. Margins were a little bit below expectations, even as revenue was largely in line. But I think what was clear is that there is a lot of underlying strength in the business. So the only question is how much will they be able to manage on the margin profile. So I think the CEO just came a few minutes back on TV and he did say that they have enough room to drive operational efficiency in the system. So that being the case, I think we'll hopefully we look forward to some sort of improvement in FY20, because FY19 was a year of investments and a lot of costs related to deal transition. So how is that going to pan out in FY20? I will have to wait for the call and then we can get a sense out there.
Right. We have okay. Just Harit, before we talk more about TCS. Now comparing TCS with Infosys, what would be your first reaction?
Yeah, I think TCS has definitely been a little bit better as far as this particular quarter is concerned, and definitely on maybe on the margin front, better than what probably Infosys has achieved. So I think that is as far as the headline numbers are concerned. Revenue, I think both were more or less okay. TCS maybe slightly ahead.
Right. We have quotes coming in from the management at TCS, so I will just hear that out for you. Rajesh Gopinathan, Chief Executive Officer and Managing Director of the company, says this has been one of the strongest growth that we have had in the last 15 quarters. Our order book is bigger than the prior 3 quarters and the deal pipeline is also robust. Despite macro uncertainty ahead, our strong exit position us very well for the new fiscal. Our full spectrum digital transformational capability and thought leadership is what is driving the strong demand for our services and making us the preferred innovation and transformation partner to our customer. The Business 4.0 framework has now become the de facto model for the enterprise looking to embrace new technology, enable business models, pursue new revenue streams, or deliver superior customer experiences. That's the word coming in from Rajesh Gopinathan. This is the point that you were also making, Harit, that the order book is looking strong, which means that execution can be done pretty well.
Yeah, exactly. So I think that has been the case with Infosys as well. Both companies have been able to report some very healthy orders in the last 1 year. So I think that is obviously that does provide some good deal of confidence in their ability to achieve somewhere close to double-digit growth for FY20.
Chandra is also still with us and listening patiently to Harit. Amit, let's come to you. We have all the details. 25.1% in terms of EBIT margins. The commentary from the management is looking strong and they are quite confident with the exit rate being high. What would you make of these numbers? What sort of analyst estimates do you expect to change? Of course, subject to change if anything changes in the commentary.
Yeah, so no, it's very clear that the large deal wins and the execution capabilities of TCS are much better, and it is actually visible in the terms of the kind of margins that they are demonstrating, the kind of attrition that they operate at. So the attrition numbers are very very critical. So at 11.3% attrition, and they're actually able to maintain that as compared to the attrition which is inching up for Infosys. So maintaining the EBIT margin in a scenario of higher attrition and higher this deal wins is actually difficult. So in TCS they have been able to accelerate the wins. So the wins in the last 3 quarters have been phenomenally well, and they're in an environment which is actually in terms of BFSI, in terms of North American BFSI, the other players are facing headwinds, but in case of TCS, they have been actually able to pull it out pretty well. So we are actually pretty confident on TCS that in FY20 they will be able to easily do a double-digit growth rate, and in terms of margins also they will be able to maintain margins. So TCS becomes the most preferred pick. Yeah.
Right, TCS becomes the most preferred pick. But when you talk about valuations, does that factor in?
Yeah, so the factors that I just mentioned, so these factors are actually visible in the valuation. So, anyways, at these valuations, where we have the comfort of future growth and margins, I will stick to that.
Right, Amit, when you now look at TCS plus Infosys in terms of numbers that they have delivered, what is the sense that you get?
Yeah, so in terms of there has been catch up in terms of growth from Infosys. So Infosys has been able to catch up the top line growth numbers in the last 2 quarters, but the margin differential has increased. In case of Infosys and TCS. So Infosys is actually sacrificing margins, and they're investing in sales, and they're inching up their on-site presence, the localization, and that is impacting their margins. So, but in case of TCS, we're not seeing that happening in TCS. So the internal functions are so robust, and they have been able to maintain their operating margins at 25-26% levels. So that is highly respectable in terms of what they have actually showed up for TCS, and also in terms of the overall performance. So their performance in BFSI, the performance in retail, CPG, and all has been better as compared to Infosys.
Right. Just request you to hang on. Mayuresh Joshi is also with us. Mayuresh, what is your first take on the numbers?
So I think numbers look pretty reasonable in my opinion. I think the revenue growth has been quite okay. When you're probably talking about the EBIT margin performance, I think it was expected to be a little bit softer this time round. I think what has probably happened in this quarter, as well as what had happened in the previous quarter, I think the higher on-site expenses and subcontracting expenses would have probably had the say in terms of how margins have panned out. But again, I think the order wins that they're probably getting at this point of time, the order book that they're probably sitting on, and the expectations in terms of execution of this order book, with attrition levels probably remaining around the same levels, if I'm not mistaken. Again, I think that probably augurs well. Now, you had put forth the point, I think, what happens in terms of valuations. Obviously, valuations are on the higher side, and the management commentary specifically in terms of BFSI, again, is going to be extremely critical, because we have seen in the past quarter that they had pointed out for banking services in particular, the European region probably looking a little bit subdued. For the insurance vertical,
Mayuresh, I have some update to give you on that. The BFSI growth was 11.6% in Q4 versus 8.6% in Q3.
Oh, so that's good. So again, I think the growth rate or the exit rate has been excellent on a quarter-on-quarter basis. So I think a large element in terms of the existing orders at hand and how they execute that, the digital percentage also moving higher. I think the things are under their control at this point of time when it comes to the broad parameters that most of the analysts probably look at. So I would say yes, I think it's a good set of numbers that TCS has posted.
Right, and when you compare TCS and Infosys, I mean, I know that you should look at them separately, but there is always this comparison of TCS versus Infosys. Both are strong.
Yeah, so there's always an inherent comparison. But what you've probably seen in Infosys case at this point of time, I think the expectations in terms of the ramp-up costs for the deal wins that they recently won, the Verizon deal, for example, I think that is obviously going to have a toll in terms of how the margin performance will be. Now, the biggest challenge for Infosys probably is investments that they still need to continue doing. And along with that, I think the higher attrition level. So I think the consolidated attrition at around 20-odd%, when you're probably talking about attrition at 18.4% on their books, I think you're also going to have a challenge on your hands in terms of increased visa costs and wage costs coming through, because the on-site expenses are also going to increase, as in the case of TCS, for Infosys as well. So I think the revenue growth is going to be not a challenge for these companies. I think the EBIT margin and how do they contain that is going to be extremely critical. Similarly, in the case of TCS, I think BFSI again is a major chunk. So I think the management commentary specifically in the aftermath of what IMF has come out in terms of global slowdown, what probably happens in terms of discretionary spends for banking, financial services and insurance separately should be monitored. So I think Infosys might have disappointed the street to a tad bit in terms of how the reported numbers were. So I think the soft stock might have some amount of a soft opening in one day's trade. But TCS, I think if the management commentary holds along with the numbers that they posted and the exit rate that they're probably mentioning, I think that should pretty well hold on to TCS and in one upon next trade.
Right. Harit Shah as well as Amit Chandra are also with us. Amit, the management will start to speak. Can you just broadly tell us, I mean, they don't give a quantitative guidance like Infosys, but what to year out for in terms of margins, the way ahead, what essentially the street would take a cue from?
Yeah, so, as you mentioned that the government doesn't provide any guidance. Yeah, but any sense on the continuation of the large deals that they have been winning the last 3 quarters? So how do they see the scenario in the second half of the year? Because we have been selectively hearing that second half we can see some kind of slowdown in the largest geography, that is the US. So some kind of sense there would be very helpful to actually decide whether how FY21 or the second of FY20 will pan out, and also any comfort in terms of maintaining the EBIT margin range in 25 to 26%, because clearly in the case of Infosys and TCS, if you will see, the large deal wins for both Infosys and TCS has been pretty strong, but in case of TCS, they have been able to maintain the margins. If you see YOY also, the fall in margins YOY for TCS is around only around 40 bips, but in case of Infosys around 300 bips. So clearly Infosys is sacrificing their and this margins for growth. So in the case of TCS, any comfort on margins, if they maintain at these levels also, we will be happy. Yeah.
Amit, thanks so much for taking our time for us. Harit, always good to get perspective from you. Mayuresh, just a few questions before we end. What essentially, these stocks have re-rated. They've been up 10% in the previous quarter from quarter to quarter. Can you just tell us what is the sense that you get in terms of stock movement on the basis of these numbers?
No, so Pankaj, I think the short-term reactions might be a little bit soft for Infosys, as I said. TCS might hold up, but I think a large element is how you probably perceive the global environment at this point of time. So if one really is talking about what IMF has said and what the client discretionary budgets are to foretell, if the second half is really soft, I think the kind of guidance that they've probably given out is in line with expectations of what might go a little bit wrong in terms of the global economy and the discretionary patterns. Now, from a sectoral perspective, I think BFSI is around 32% for both Infosys and TCS, roughly, followed by retail CPG, and you've got energy and telecommunications followed with that. So in that respect, again, I think the spending patterns for all these industries are going to be extremely critical. So I think one region might offset the strengths in the other region, as I mentioned. So I think there might be some softness in the European region getting offsetted for the banking part from the North American markets, and vice versa for the insurance part of the business. So again, I think the ramp-up costs that you're probably seeing in terms of execution of contracts that they've probably won, the on-site expenses that probably go up, and the subcontracting expenses that go up probably curtail their margins to a fair bit. But the street probably has cognizance of all these numbers, specifically on the EBIT front, and a fair bit of an idea that I think if the global slowdown has to happen, it will also impact the dollar revenue and the constant currency revenue growth. So again, I think there might be short-term reactions to the stock prices, but I think they will adjust themselves in terms of how the global economy is phasing up and how these stocks are phasing up in lieu of that as well.